March 2018. I had just finished my MBA and I decided to do something very, very stupid. I decided to opt out of placements and start up with a couple of my batchmates. And we wanted to build a brokerage business, a stock brokerage business like Zerodha. Unfortunately, we didn't have the money or the funds needed to actually set up the business, so we decided to do something instead. We decided until we had the funds secured, we could actually go out and do a bit of market research and see what people actually wanted. And that's when we met this very interesting broker in Ahmedabad. He said, listen, forget about the brokerage business, do something else. See, in 2018, there was this massive rage around SME IPOs. SME meaning small and medium enterprises, and IPO meaning companies that were trying to raise money from the public. Now, the thing is, the opportunity in this space was immense and most people already knew it. I mean, imagine if you could somehow snag up Infosys as a stock when it was simply an SME, a small company that was probably worth around 10, 20, 30 crores. You could have become a billionaire. And so many people wanted to invest in these IPOs, these small and medium enterprise companies, just to find the next Infosys. And that's why the broker that we just met, the gentleman, suggested that we forget about the stock brokerage business and instead focus on these IPOs, break down their business, analyze the financials, talk to promoters, and tell people if they should invest in SME IPOs or not. And we were like, yeah, that makes sense. And that's when I was first introduced to the world of IPOs. And I soon began covering these SME IPOs and writing about them, telling people if they should invest in these stocks or not. The only problem was our startup wasn't going anywhere, and most of these SME IPOs were straight up fraud. I mean, I wasn't going to find the next Infosys here, and so that was a bit of a bummer. The upside, however, was that it did teach me how to read one of these documents. Now, this is a DRHP, and in this video, I'm going to explain to you what I learned covering almost 50 IPOs during the last 5 years, and also tell you how to go about IPO investing in general from what I've learned in these past 5 years. So hopefully you're as excited as I am, because this video is going to be amazing. First things first. What is a DRHP? A DRHP is a draft red herring prospectus. It's a document that companies have to prepare before they go public so that they can give information to people who are going to be investing in the IPO. For instance, in this document, the company will tell you what they do as a business, some of the risks associated with the entities, and also how they're going to use the money you've generously given them. And so it contains a wealth of information, and it should be the first place you go to before you invest in an IPO. The only problem is that this document is thick. It's very, very thick, and it's almost impossible to get through the entire document without dozing off. For instance, take this document. This is Zomato's DRHP, and it's nearly 400 pages long. There's absolutely no way anybody is going to read 400 pages just to invest in this IPO. That's not happening. But the truth is, you don't have to read the entire 400 pages. Instead, all you need to do is probably read 40 to 50 pages, and even then, you can pick and choose what you need to focus on. So you don't have to worry about reading the entire document, because the entire document isn't what you should be reading in the first place. Instead, you should be reading these 5 things. So first, you have the summary. This summarizes the entire document right from the top to the bottom. It includes everything: an overview of the business, an overview of the industry, some facts associated with the promoters, and pretty much everything that you need is summarized in this early part of the document. Next, you have the risks section. Here, the company will outline everything that could possibly go wrong with the entity. And I think this is one of the more important sections that most people should be reading. However, it's not the end of things. Afterwards, you have the business overview, where the company describes their business in great detail. Now, I know most people think they already understand businesses fairly well, especially when they're investing in an IPO. But once again, this is a more in-depth explanation of what the company does. And you have the industry overview, explaining everything that you need to know about the industry that they operate in, to hopefully give you an idea about how the company is shaping up in a market that could probably be growing, underperforming, or whatever. And then finally, you have the financial sections where the company outlines everything that you need to know about their top line, their bottom line, how the debt is changing over the years, and any other financial ratios that you may want to consider. So that's about it. The 5 parts in these documents total up to about 50 to 60 pages, and this is what you should be focusing on. So let's go through each section one at a time, starting from the summary. Let's use Nykast DRHP as an example. Now, in the summary section, you will see a quick overview of the business and the overview of the industry. Now, usually I skip this because we will obviously read more about this in greater detail. So yeah, I mean, you don't have to focus too much on that. And besides, it's really watered down. You're not going to find anything meaningful here. Next, you will see details about the promoters and the offer size. And this is where things get a little bit interesting, because if you see the table here, you'll see that almost all of the details are blacked out. Now, don't worry about this. This is normal because the company don't divulge these details until they're much closer to the IPO. That's when the draft red herring prospectus becomes just the red herring prospectus. The draft is removed and everything's finalized, especially the valuation of the company. Because if Nykaa told you exactly how much of the company they're offering and how much they're trying to raise the money, you can actually calculate what the value of the company ought to be. So this information comes much later and you don't have to worry about the blacked out details just yet. The next table is very important because there you will find the objects of the proceeds. What does that mean? Well, this is where the company tells you how much money they're raising and how they plan to actually use it. So if you read Nykast DRHP, you will see that they're planning to raise the money in the hopes of paying back some of their debt, probably allocating some of this money to marketing, and then finally investing in retail stores. Now, that's okay. These are normal expenses. But if you see that a company is only raising money to pay back all of its debt, then you should probably investigate it a bit more. You could then go and ask, okay, why do they need this much money and why do they have so much debt? Should I be concerned about this? Are they not making enough cash? And should I even opt out of the IPO? I mean, these are questions that you need to ponder once you look at the objects of the proceeds, because that's where you will know how the company is planning to use your money. And sometimes you won't even have the objects of the proceeds section because the company isn't looking to raise money and actually put it to good use. Instead, they're simply raising money so that they can give an exit to some of their existing investors. Take a look at the Tata Technologies IPO. In it, you will find a different section titled Objects of the Offer. And they'll tell you something like this. They'll tell you, listen, we don't need the money. It's just that our investors are looking to exit. So we are raising this money so that we can pass on all of the cash to them. And in return, you'll get the stake that they'll be divesting. That's about it. Now, you can look at this and come to your own conclusions. Is it a good thing or a bad thing? But needless to say, this is a section that you should focus on one way or another. Anyway, you will find more details about the objects of the proceeds if you keep reading the document. But in my humble opinion, this is more than enough. It'll give you a fair idea of what you need and you can move on. The rest of the information pertains to the promoters, a brief overview of the financials, and any outstanding litigation, meaning cases against the promoters. Now, this can be very tricky because somebody who's reading the DRHP for the first time will probably see there's a bunch of cases against the promoters and the key management personnel and will probably be very scared about investing in the IPO. But the truth is, this is to be expected, especially for large companies. I remember a case where one customer decided to pursue the promoter and actually file a criminal case for goods worth about 40 rupees. Honestly, I mean, if that kind of thing can happen in this country, you shouldn't be too worried. However, I also remember another case in which the promoter was actually accused of shooting at somebody. Now, that's something you probably need to be concerned of. And so you'll have to make the distinction. Are these cases actually something that's concerning or is it something too frivolous? I mean, that's a decision that you will have to make. And with that, we can actually move on to the next section. But before we do that, a humble request. Now, if you haven't done it already, please do consider subscribing to the channel and perhaps liking this video as well. Because every time you do these two things, it gives me more motivation and incentive to keep developing more videos like these, talk about stocks, ideas, and hopefully give you an idea about what I've learned about investing in general. Hopefully, this will help you become more financially literate and financially independent as well. So if you haven't done it already, please do consider subscribing to this channel. It will mean the world to us. And with that, let's continue. Okay, so if you're actually reading the DRHP, you'll see that the risks section actually comes before the business and the industry overview. However, I don't like to read these specific sections in the same order because I believe that reading the business overview and the industry overview will give you a lot to think about, and you may have many questions about the business model that usually gets answered in the risk section. So my recommendation is to actually skip the risk section for now and actually move on to the businesses and the industry section so that you can come back to it later. So let's look at the business overview section now. Now, I know that most people will already know a bit about how the business works, especially if they're planning on investing in an IPO. But I promise you, reading this section is extremely useful, even if you think you know everything there is to know about the business. Because I remember reading about Zomato's IPO the first time and just going through this section and being blown away completely. Even though I knew a lot about what Zomato does, I still walked away having learned so many new things. I mean, look at this chart. This chart briefly and concisely explains how money moves once you place an order on Zomato. And honestly, there's no better representation than this. I truly believe that in the DRHP, you will find many such examples which will give you a lot more clarity about how businesses operate in general. And I believe that is extremely useful. So with that, we can move on to the next section, which is the industry's overview section. Now, this is a very tricky section to navigate, because usually you would want to know exactly how the industry prospects are shaping up before you invest in any company. And the funny thing is, these reports are also very well written and thorough. So there's definitely a lot to learn from just reading the industry overview within the DRHP. Unfortunately, the problem is these reports can be a bit biased. I mean, think about it. If I paid you to write a report so that I could put it in my DRHP and promote it during the IPO, you wouldn't exactly be critical of my industry prospects, no? I mean, if you were, I would simply go to somebody else who would be less critical. So everything you read here could probably be tainted by virtue of there being a conflict of interest. Take the DRHP from HDFC AMC, the asset management company. They distribute and sell mutual funds, and in the DRHP you'll find a report from CRISIL showering glowing praises on the mutual fund industry as a whole. They write things like robust GDP growth seen in the past few years. Obviously, if the GDP growth is higher, more people will likely invest in mutual funds. They also write things like household savings improve, which means that higher savings translate to more investments in mutual funds. There's also mentions of how the assets under management within the mutual fund industry has been growing, and also revenue and profits in the sector have also been following the same trend. So you would read this report and come out thinking that the mutual fund industry is amazing, everything is great, and you should be investing in the IPO ASAP. Unfortunately, if you had done that believing the CRISIL report, you'd have been in the mud by now, because the stock hasn't gone anywhere since the IPO. And no, it's not because the mutual fund industry isn't growing. In fact, it's growing just the way CRISIL had actually predicted. Unfortunately, the reason why HDFC AMC has probably not gone anywhere since its IPO is because of all the things that CRISIL didn't mention in its report. Primarily the things related to regulations, in that government regulations in this space can change overnight. And the fact is, since the IPO, the SEBI has come in and clamped down on asset management companies and prevented them from charging the fees as they would have liked, which meant that this has had an impact on the company's earnings. And obviously investors are paying attention and they really don't want to buy the stock as of now. So in many ways, even though the industry overview can contain a lot of interesting tidbits, you have to remember to take it with a gigantic pinch of salt, because they are usually biased. In fact, this is one of the reasons why my favorite section is the risk section, because this is the place where the company has to admit everything that it doesn't want to admit. See, I already have 100 reasons to invest in an IPO. The only thing that I need is give me some reason to not invest in the IPO, so that I don't end up looking like a fool if the company doesn't perform well in the future. And the risk section will have all the juicy details that you need just for this purpose. I remember reading the Mamaearth DRHP and the risk section and then thinking, oh, what did I even know about Mamaearth in the first place? Because see, until then I'd assumed that most of Mamaearth's products were built in-house and they have special patented formulas because of all the marketing that I'd seen. And then when I read the risk section, I find out that they don't even manufacture their own products. They do contract manufacturing and they have 0 patents to their name. And suddenly everything I know about the business changes. My perception about the company also shifts. And this is one of the reasons why I recommend everybody to go to the risk section. Now, the unfortunate bit is that the risk section can be particularly long. And most people don't want to read the entire section cover to cover because they're just like, oh, who has the time? Now, fortunately, you don't have to read the entire section because it's actually divided into 3 parts. You have risks associated with the business, and then you have external risks, and you have risks associated with the IPO itself. Now, the last 2 sections, external factors and risks associated with the IPO, they don't change much. Even if you look at other DRHPs, you'll see that there are a lot of similarities. For instance, they usually talk about things like, hey, what if there's something wrong with India's growth in the future? What if there's a terrorist attack? What if there's political instability? Well, it affects Mamaearth the same way it affects Zomato. And so you don't have to keep reading it over and over again. Once you read it, you'll pretty much be done. The only thing you should then focus on is the risks of the business, and that's actually good enough. And once you're through with that, you can finally look at the financial section. Now, the financial section is a bit of a weird one because I could make an entire video explaining how to read income statements and balance sheets, and even that wouldn't be enough. So I'm not going to go too much into this whole section. Instead, I'm just going to tell you this much. If you just want to get a quick overview of what's happening in the company, just look at the top line figures, the revenue figures, just look at the profit figures or the EBITDA figures, which is the earnings before income tax, depreciation and amortization, and just look at the total debt. If the company has a lot of debt, maybe that's something you should be worried about. And maybe plot all of this in a chart and see if there are any anomalies, a sudden dip or a sudden rise. And if you do find these anomalies, you can go back to the risk section and check for an explanation. Usually you will find one. For instance, if you look at the Zomato's DRHP, you'll see that in their financials, there's a dip during the COVID year, which is 2020. And it's to be expected, right? Because we had the lockdowns and all of that. And if you go to the risk section, you'll actually find a very prompt explanation of precisely what happened during these months. So that can give you a better idea of why the revenues are tanking, or if they're improving, vice versa. So that's with the financial section. And once you're through with that, you can probably look at the valuation once the company makes it public. All you have to do is wait for the final RHP, that's just the red herring prospectus without the draft. Press Ctrl F, type in basis for the offer price, and then go to the section where they've listed all the competitors and the valuations at which they're trading, also the valuation at which the company itself is listing, so that you can compare these companies and see if it's still worth investing in the IPO. That's it. That's all you need to know about reading the DRHP. It's an excellent place to start. And if there's an IPO coming in the next few months, I urge you to employ all of the things that I probably talked about in this video and do it for yourself and see if you can walk out of it with something more insightful. Now, I wish I could tell you that reading the DRHP alone could make you an ace investor when it comes to IPOs. Unfortunately, that isn't actually true. The reality is that even if the long-term prospects of a company are terrible, the IPO could still be a blockbuster if the company can spin the right stories. Take for instance the example of Jet Airways. When it IPO'd all the way back in 2005, it was one of the hottest companies out there. The issue price was set at 1,100, and on the first day of trading, the stock had already breached the 1,200 levels. It was euphoria. Unfortunately, after just 1 month of trading, the stock never reached the 1,200 mark again. In fact, after that, it never even reached the issue price. It dipped, and it continued to dip, and it dipped some more until now, when the company is actually in life support. It's practically dead. So you have to wonder, what do you do about cases like these? Well, there is something that you could potentially do, and that's looking at the grey market premium. What is a grey market premium? Well, let me put it this way. Even before the shares are actually allotted in an IPO, people will start buying and selling shares on the side. I mean, they're not doing it on any official platform. In fact, they're actually operating on trust. So they're simply saying, hey, listen, if I get the shares, I'm willing to sort of sell it to you at this price. And are you willing to buy it from me at that price? And if somebody goes, yeah, that's good for me, then that's a grey market price. That's the price at which the stock is trading even before it is actually listed on the platform. So depending on what price at which the buying and selling is happening, you can actually look at this and sort of get an idea of where the IPO is headed. For instance, when Nykaa was gearing up for its IPO, you could see that the shares were trading at a premium of about 65% in the grey market. That is, the shares were trading at a price of nearly 1,900 rupees when the issue price was merely 1,125 rupees. So the extra price that people were willing to pay in the grey market is called the grey market premium. And so you could argue now that, listen, all I have to do then is watch some news portals, see if the shares are trading at a premium or not in the grey market. And then if it is trading at a premium, I'll simply invest in the IPO and then make money. Obviously, when Nykaa went public, it actually listed at a premium of even higher than 65%. In fact, it listed at a premium of 80%. So you would think that this is a foolproof plan to make money, no? Well, not quite. There are some problems. Let me give you an example. When an IPO opens, investors have a few days before they can actually place their bids. Now, during this time, you can see what other investors are doing and if they're actually subscribing to the IPO. If not enough people are subscribing to the IPO, you can get a sense that the IPO may not be going too well. And this will also be reflected in the grey market premium. So in the first few days, you could actually have no premium. In fact, the grey market could be quoting a discount, a price below the issue price actually. So you could be led to believe that this IPO is a dud. But then in the last few days, all of a sudden the IPO could gather steam, and in the final day, suddenly the issue could be oversubscribed. There could be more demand than there is actual supply. And at which point you'll see that the grey market premiums will also start going up. So just because there isn't a premium in the first few days doesn't mean that it will be the same case in the last few days as well. And so as the grey market premium keeps changing, well, you'll probably have to also change your tune. And the second issue is that just because the shares are quoting at a premium in the grey market doesn't mean that they'll actually list at a premium when they go public. In fact, there are many cases when shares were trading at a premium in the grey market only for the stock to then fall flat during the actual IPO. So it's not actually foolproof by any stretch of the imagination. And finally, there's an even bigger problem. If you are investing in IPOs this way, then it means that you're not in it for the long haul. Your only objective is to invest in the IPO, see if it's going to list at a premium, and if it does, sell the stock on the first day, take away what profit you can, and that's about it. And you're done with it. And the funny thing is, if you are doing this in the knowledge that the stock and the IPO will be a definite blockbuster, then it's likely that others will also be doing the same thing. And if they're doing the same thing, then the demand is going to be so excessive that not all retail investors will actually get the shares they want. So if there are 100 shares floating and 200 people are bidding for those shares, only 100 lucky people will actually be allocated the shares, which means it's a lottery at this point. Some of them will be lucky, some of them not so much. Some of them will get the shares issued during the IPOs, others will simply be returned the money that they had given the company in the first place. So it's hard to argue that this is IPO investing at all when all you're trying to do is which way the crowd is going. And finally, there's one last thing. It's that IPOs in general haven't created a lot of wealth for investors. For instance, in the financial year 21-22, you had about 51 IPOs in total, and 19 of them actually fell below the issue price. And some even tanked horribly, like the Paytm IPO or the Delivery IPO or even LIC IPO for that matter, which is now trading at a price that's almost 35% lower than the issue price. So if you're investing in anything that moves, especially just because it's an IPO, then maybe you should be mindful of these facts. In any case, I hope this video gives you some idea about IPO investing and navigating the grey world of market premiums and reading DRHPs in general. Hopefully you can use this information to get better at investing in general and hopefully IPO investing as well. And if you want to probably watch more videos on how to analyze IPOs, you can check out these videos on Tata Technologies and Mamaearth. These are IPOs that I covered in the past, and I'm pretty sure there's a lot of information there as well on stuff that I found reading the DRHP and in general just valuing the company during the IPO and all of that. So with that, I just want to tell you, please like this video and maybe leave your thoughts on the comment section below, and also subscribe to this channel if you like what I'm doing. And yeah, I'll see you again next week with a brand new video. Until then, bye bye.